Ladies and gentlemen, good day and welcome to the SD Retail Limited H2 and FY26 Results Conference Call hosted by Kirin Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mr. Ganesh Nalawade from Kirin Advisors Private Limited. Thank you, and over to you, sir.
Thank you. On behalf of Kirin Advisors, I welcome you all to the conference call of SD Retail Limited. From management team, we have Mr. Hitesh Ruparelia, Chairman and Managing Director, Mr. Utpal Ruparelia, Managing Director, and Mr. Ritesh Sarawgi, Chief Financial Officer. With that, I now hand over the call to Mr. Utpal Ruparelia, Managing Director of the company, for the opening remarks. Over to you, sir.
Good afternoon, everyone. I am Utpal Ruparelia, Managing Director of the company. Thank you for joining us today for SD Retail Limited earnings call for the half year and financial year ended March 31, 2026. It's a pleasure to connect with you and share our performance highlights, strategic progress, and outlook as we continue building Sweetgreen into India's most trusted sleepwear brand. At SD Retail, we believe sleepwear is more than apparel. It's a daily ritual of comfort, expression, and care. Our mission is to make sleepwear an essential part of every Indian household, blending thoughtful design, inclusive sizing, and practical elegance for all the age groups. Over the past few years, we have successfully transitioned from a trade-led model to a modern consumer-first brand with a robust retail and digital presence. Customers across India throughout our exclusive brand outlets, multi-brand outlets, large format stores, and leading e-commerce platforms. We operate in a category that is deeply personal and yet highly underpenetrated. Sleepwear is worn nearly 70 hours a week, but occupies less than 10% of wardrobe space. This gap represents one of the most compelling opportunities in Indian apparel, and we are committed to bringing it through continuous design innovation, immersive retail experiences, and powerful brand storytelling. I now request our Chairman and Managing Director, Mr. Hitesh Ruparelia, to take the call forward. Thank you.
Thank you, Utpal. Good afternoon, everyone, and welcome. I, Hitesh Ruparelia, will be sharing our performance, key developments, and future outlook with you during this session. I'll start with operational highlights. Moving on to our operational highlights, retail continues to be our primary growth engine. I'm pleased to share that as of March 31st, 2026, our retail footprint has expanded significantly to 75 exclusive brand outlets, up from 51 stores in FY25. This rapid scale reflects the successful execution of our expansion strategy across both COCO, which is company-owned, company-operated, and COFO, which is company-owned, franchisee-operated formats. Furthermore, several additional locations are already under fit-out and are scheduled to launch in the coming months. Our total EBO retail area now exceeds 36,371 square feet, strategically diversified across high footfall formats. 46 stores are located in premium malls, 21 stores on high streets, and 8 stores in major airports. These stores are delivering robust productivity, achieving an impressive annualized sales per square foot of 16,549, while maintaining healthy gross margins exceeding 60%. Beyond our standalone stores, our pan-India footprint remains highly accessible, spanning over 2,500 multi-brand outlets, MBOs, and nearly 55 points of sale across large format and regional chains. In terms of financial performance for this segment, our EBO revenue grew by 111% during the full year and by 104% during second half. Total EBO revenue for the year stood at 46.45 crore in financial year 25-26 compared to 22.04 crores in financial year 24-25. On the digital front, the substantial investments we made towards growing our e-commerce website are yielding strong results. Our D2C platform delivered a revenue of 4.83 crore in FY26, up from 2.83 crore in FY25, representing a robust growth of 70%. This digital momentum strongly complements our physical retail engine as we build out our unified omni-channel ecosystem. Now I will turn to financial performance. Let me now take you through the financial performance. For the full financial year 2025-26, our total revenue from operations stood at 195.97 crore, representing a year-on-year growth of 13.25%. EBITDA for the full year came in at 16.53 crore with an EBITDA margin of 8.4% compared to 14.3 crore in FY25. Our profit after tax was recorded at 9.78 crore as against profit after tax of 8.56 crore in the previous financial year. Turning to the second half of the year, for H2 FY26, we reported revenue from operations of rupees 117.68 crore, representing growth of 16.1% over H2 FY25 revenue. EBITDA for H2 stood at 40.35 crore, translating into an EBITDA margin of 12.2%. Profit after tax for the half year stood at rupees 9.65 crore with a PAT margin of 8.2% as against 9.0% in H2 FY25. This margin compression was primarily driven by intentional upfront investment in corporate and operational manpower to fuel our future growth alongside an increase in other overhead and costs. From a channel perspective, our exclusive brand outlets delivered the highest growth and emerged as a massive standout. EBOs contributed 23.7% of our total revenue, up significantly from 12.7% last year. This stellar performance was driven by both our aggressive footprint expansion and a healthy double-digit same-store sales growth, which is SSSG. Strategic direction. Our growth roadmap remains firmly anchored in our proven 3W framework, focusing on wear time, wardrobe share, and wallet share. When you look at the numbers, sleepwear occupies nearly half of a consumer's week in terms of hours, yet it currently accounts for just a single digit of wardrobe volume and an even lower percentage of overall apparel spend. We view this gap as a major structural opportunity. Our focus is on shifting dated sleepwear habits into style-led, comfort-driven adoption across all consumer segments. To capture this, our product architecture now spans mood-based collections with increasing relevance for gifting, travel, and family occasions. We are seeing exceptionally strong momentum in North and West India. Ultimately, our brand's emotional and functional appeal, whether for pajama parties, lounging, or self-care rituals, continues to deepen across all ages and life stages. Market dynamics and financial resilience. Reflecting on the macro environment, FY26 saw a muted discretionary consumption across India, driven primarily by inflationary pressures, increase in fuel prices and other directives issued by Government of India. It seems that discretionary consumption will be under pressure in the year ahead also, and will need continuous financial prudence and cost optimization to steer the business positively in such challenging environment. Despite these dynamic external challenges over the past year, we remain effectively focused on executing our core strategic priorities and driving efficiencies across the value chain. Our emphasis on disciplined cost management, product cost optimization, store network optimization helped us maintain strong financial stability, while targeted product expansions laid a solid foundation for future growth. While the broader demand environment remained challenging, we continuously strengthened the factors within our control. We enhanced product quality, introduced improved designs, and expanded our style portfolio to better address evolving consumer preferences. Simultaneously, we invested heavily in building and empowering our internal design team to stay well ahead of market trends. This balanced approach of innovation and operational consistency has enabled SD Retail to remain closely aligned with the needs of diverse, growing and loyal customer base. Geographic footprint and store experience. Our north and west zones remain our primary strongholds, currently housing 63 stores, while the south zone is gaining steady traction with 11 operational exclusive brand outlets, complemented by our initial footprint of one EBO in the east zone. These physical locations function as crucial brand experience centers where customers directly engage with the Sweetgreen's lifestyle. To maximize store productivity, we continuously refine our retail operations through highly efficient formats, inclusive sizing options, and mood-based visual merchandising designed to evoke warmth and relaxation. Every store environment is meticulously optimized with curated lighting, tactical fixtures, and brand storytelling that specifically resonates with the consumer mindset between 8 p.m. and 8 a.m. To maintain high operational standards and a consistent brand image across all regions, we have formalized strict visual merchandising protocols supported by regular retail audits, while simultaneously leveraging real-time consumer feedback to directly inform and adapt our product design and range planning. Technology and digital strategy. Technology remains central to our growth strategy, underscored by the complete migration of our core systems to a cloud-native infrastructure that enables real-time data visibility and faster, more informed decision-making. On the digital front, we are actively strengthening our proprietary e-commerce platform to deliver a seamless, unified omni-channel experience by fully integrating inventory management, reducing delivery turnaround times, and offering highly personalized content. This strategic integration is expected to drive robust sales growth across both our own website and prominent online marketplaces like Myntra. Furthermore, we are exploring data-led collaborations with various lifestyle platforms and even partners to continuously expand our customer touchpoints and deepen brand engagement. People and processes. Our ongoing growth journey is powered entirely by our incredible people. We want to take this opportunity to recognize our store managers and ground teams who embody the Sweetgreen spirit every single day. To ensure flawless execution across our growing footprint, we have expanded our retail and operations teams by bringing in specialists across merchandising, customer insights, and visual merchandising. Operationally, we are focused heavily on simplification. We have taken proactive steps that are helping us scale our business with discipline, consistency, and structural strength. Future outlook. Looking ahead to financial year 27, we remain highly confident in the structural growth of the sleepwear category. As the lines between sleep, lounge, and leisure wear increasingly blur, SG Retail is uniquely positioned to lead this transformation. With an expanding EBO network, rising D2C traction, and ongoing investment in product innovation and customer experience, we are poised for a long-term profitable growth. Our primary focus is on scaling Sweetens into a truly national brand, both in reach and resonance. To achieve this, we aim to deepen our EBO footprint in Tier 1 and Tier 2 markets, specifically targeting airports, high streets, and premium malls that currently lack dedicated sleepwear destinations. Our vision is clear: to establish a Sweet Dream store in every major shopping district. Operationally, we are building a unified omni-channel ecosystem featuring integrated stock visibility, seamless loyalty benefits, and faster order fulfillment. On the product front, design teams are actively working on coordinated sets and fabric innovations tailored to India's diverse lifestyle. To further deepen customer relationships and enhance lifetime value, a unified CRM and comprehensive loyalty program will soon be rolled out. We firmly believe that sleepwear category is at an inflection point. With our focused strategy, highly differentiated product line, and technology-led retail model, SG Retail is well positioned to lead this industry transformation. In conclusion, I want to extend my sincere thanks to our shareholders, customers, partners, and the entire team for their continued trust and commitment, reinforcing our belief that the future of sleepwear in India is incredibly bright and that Sweetens will continue to be at the heart of it. Thank you, and we now welcome your questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question, one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Raj Shah from Shah Ventures. Please go ahead.
Yes. Good evening. So, I have some doubts. So you have expanded EBO count to 75 stores. Can you please help us understand the mature stores economics versus newly opened stores in terms of sales per square feet, EBITDA contribution, and payback period?
So, thank you for your questions. We have two kinds of stores: the stores which have matured over 1 year and the stores which are opened in the current financial year. The stores which have matured, one second. I'm just pulling out data for your questions. So for the matured stores, we have 51 stores which were operational for the financial year 25, and the EBITDA percentage is 13.88%. And
Payback period.
Payback period across is 1.5 years.
Okay. And among mall stores, airport stores, and high street stores, which format is delivering the best profitability? And throughout currently, how should we think about the future expansion mix?
So, in terms of productivity, stores the highest activity. Uh,
I'm sorry to interrupt you, sir. Your voice is breaking. We are unable to hear you.
Is it better?
Yes, please go ahead.
So the airport stores have the highest productivity, followed by mall stores and the street stores. So we have 47 mall stores as of now, 8 airport stores and 20 high street stores.
And do you also think about like a future expansion mix as well?
So future expansion mix will continue to expanding at airports and malls because these are no-brainers. The high street is a very calibrated expansion for us.
Okay, that's great. And also you have mentioned annualized sales per square feet of approx 16,500 rupees.
549, yes.
So is this portfolio average, is it improving with the scale? And
Yeah. So I'll tell you the sales per square feet for financial year 24 was 10,390. It improved to 15,998 in financial year 25 and further improved to 16,549 in financial year 26. Our average store size, which was 462 square feet in financial year 24, reduced a bit to 448 square feet, and now is averaging 485 square feet across 75 stores.
okay. And also, can you also give me the clarification about what is the benchmark level that management believes?
In terms of benchmark of what? Because there are various parameters. Any specific parameter you want?
For the portfolio averaging.
So if I have to tell you, last financial year, we were averaging 70 lakhs productivity per store per annum, which we have improved to 80 lakhs per store per annum in the current last financial year ended FY26, and we are further going to push it another 10% in current financial year.
Okay. Okay. Thank you, sir. That's all from my side. That's it.
Thank you, Raj.
Thank you. Participants who wishes to ask a question, please press star and 1. The next question is from the line of Priyansh Miri from NJP Family Office. Please go ahead.
Hello, sir. Hope I am audible.
Yes, you are. Please go ahead, Priyansh.
Yeah, thank you. So, sir, my first congrats on the good set of numbers, sir. My few questions is around the operation metrics. So, as you mentioned, our portfolio of almost 75 PBOs has an average store size of 450 square feet, right?
Hello?
Yeah. Sir, I'm asking, our out of 75 PBOs, our average store size is around 500 square feet, right?
Yeah, 485 to be specific.
485. Yes. Sir, so I just want to understand, what are the setting up costs for any store? Like, what is the upfront in terms of store, like, interiors, racking and all this? And also, what is the working capital that while opening a new EBO, the store owner has to maintain at his end?
So first I'll give you an overall metrics and then we'll define in various models. So for opening a, assuming 500 square feet store, the capex would be around 20 lakhs. The deposit would vary between 10 lakhs to 15 lakhs. And the inventory at cost will be about 10 to 15 lakhs. So on an average, 50 lakhs will go as invest for operating a store, which gives a productivity of about 70 to 80 lakhs of business of financial year. This is the overall metrics. Now, if we go for a COCO store, company will have to invest all 50 lakhs. If we do a COCO store, then a lot of heavy lifting is being done by franchisee because capex is done by them and inventory deposit is given by them. Only the investment from company side in a COCO model is rental deposits, which will be anywhere between 10 to 15 lakhs, or if it is an expensive mall, between 15 to 25 lakhs. I hope this answers your question, Priyansh.
Yes, sir. Sir, your voice was breaking in between. Setting up cost is between 15 to 20 lakhs, and the inventory that it holds, what was the figure for that?
No. The capex is 20 lakhs.
And the inventory or the
inventory at cost is about 10 to 15 lakhs.
10 to 15 lakhs. Okay.
And the deposit for rental deposit, which is a component, is again 10 to 15 lakhs.
Okay. Understood, sir. Sir, my next question is on the operating profit seasonality. So why in our F1 half yearly numbers, we have almost margin close to 3 or even I think negative also, right, in few times. So what was the variation? Like for second half it's 12% and in first half year it's 3%. What is the scenario on this?
So structurally, if you see our business, the H2 is always a bigger contributor than H1, right? So if you have to dissect the exact numbers, for the year ended March 26, right? The H2 numbers were 117 crores as against 78 crores for H1.
Yes.
Right. So structurally, the business is spread like this. H2 is always bigger historically for us. But as we move forward, as the EBO contribution keeps increasing, this will get more or less evened out on a scale of 3 to 5 years.
Okay. So if my understanding is correct, sir, being second quarter being the festive season, hence we have a higher sale. Thus our fixed cost gets nullified in that quarter.
Apportioned on a larger sale. The fixed cost gets apportioned on a larger sale base. So usually if you see the H2 report, we report high percentage of EBITDA, PAT, and all the numbers.
Sir, one question on our business strategy. Right now we are clocking almost around 20-25% of top line growth, right? If I envision a scenario where suppose we want to target say 40 or above 50% revenue growth year on year. So what are the key bottlenecks that you see? If that gets resolved, is there an issue with regards to marketing part of it, or this industry has 18 or 20% growth? What exactly is the reason? Why? Just to explain this further, why I'm asking this is the segment that we are targeting, sir, is very much fragmented one, right? So a lot of unorganized players is there. So your company being in a good niche, I'm just want to understand why we are not growing as a 40 to 50% numbers. Can you explain?
Our current growth is in the range of 15% annualized. It's not 25%. Second thing, if you understand structurally, we are a large trade-led brand, right? A large portion. The last financial year, the contribution of EBO is around 23%, right? Which has gone up from 12.7% previous year. So because of this exponential growth in a chosen channel, if you see EBO is a channel, we are not growing 40-50%, we are growing at 111%. If you take digital channel or e-commerce, we have grown by 70%. So we are in a very aggressive growth path, but when it converts to company level growth, it mutes down to about 15%, and it's anywhere between 15 to 20% at company level at this point of time.
Understood, sir. So as we scale more on EBO, overall growth rate will also be increasing. That's a fair understanding.
Yes, of course it will increase.
Okay. Sir, any target that you have set, number of EBOs that we are planning to open in next two financial year?
Yeah, we continue to open about 8, 9 EBOs a quarter.
8, 9 EBOs a quarter. Okay. So I don't think then we'll be required to raise equity for this, right? It will be maybe debt. Yeah.
Yeah, we have not planned equity raising immediately for any purpose.
Okay. Okay, sir. I will join back in the queue, sir. Thank you for answering my question.
Thank you, Priyansh.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question.
Hopefully I'm audible, sir.
Yeah, I just want to reconfirm. Am I speaking to Darshil?
Yeah. This is Darshil
Okay.
here, sir.
Yeah, please go ahead. Darshil. Okay.
Yeah. Hi, sir. So, sir, I just wanted to understand in terms of our growth, like, sir, we've increased, I think we had 50 stores last year, now 75. So, in terms of FY27, like, what is the term of growth that we can see? Because these stores that we launched are also now maturing. So, can we see a significant jump in revenue this year? Because, we've invested significantly in store building. So, how do you look at it, sir?
Yeah, there will be again a significant contribution and jump this financial year as well. You're right about it.
So what would be the growth rate, sir? Like in terms of revenue, sir, how much could we expect this
Our
year?
aim would be again, our aim would again be doubling from here.
In how much time, sir? Doubling revenue, we mean?
Doubling EBO. I'm talking EBO as a channel. Our
Okay,
expansion and focus is on EBO.
Yeah. So I understand we want to increase our EBO, but that will also come with some commensurate increase in revenue, right, sir? So last year we grew around 13%. The year before that, I think around 6-7%. So in FY27, all the investments done in last 2 years should, kind of start fructifying, right? So what is the growth? Like, I don't want an exact number, a range will also do, but at least we can see 25% growth this year because, there has been...
Yeah, high double digit. Yeah, high double digit growth. So from 7 to we have grown to 13. So, I mean, that's the trajectory you can safely consider.
Okay, so high double digit, I would at least take 20% as base case, sir, because you said 7 to 13.
I'm not supposed to quantify like this, but yeah.
Okay. Understood, sir. Understood. And sir, in terms of margins, sir, now that, a lot of stores would have also been, maturing. So, sir, can we look at double-digit margin for the full year, sir?
We are already in a double-digit margin.
But then H1 also comes single digit, na?
No, you're talking company level?
Yeah, company level, sir. Company level.
Okay,
sir.
I was talking about the channel level. No problem. Company level, there is still some time to go to double digit. The reason being that simultaneously there is a structural growth in our category. So we are investing into manpower, we are investing into technology, and we are also investing into marketing. So the focus now is how soon can we accelerate these low-hanging things, right, and move to a faster growth trajectory instead of, focusing on delivering a higher EBITDA.
Okay. Fair enough, sir. Understood that, sir. And sir, the, EBOs that, we want to, raise, so most of it will be franchisee or, we'll do a certain level of capex. So what would be the capex figure that, we would want to do in FY27, sir?
CapEx figure, it entirely depends on what is the contribution of store that are being opened in what format. If you do a COCO, it will be fairly high. Suppose assuming that we open 20 COCO stores, we'll need around, say, 6 crores of CapEx for that, and vice versa if it is a COFO store, right? We also plan to open some large COCO stores in the current financial year, which are bigger in size. So our average size is 485 as of now. But we would want to open some 1,000 square feet, some 1,200 square feet stores also with our own CapEx, because in past 1 year we have opened about 4 stores which are in excess of 1,000 square feet, and they are giving us good productivity overall. So our focus is going to keep increasing the size of the store, which brings operational efficiency, and it also delivers higher top line.
Okay. So I can assume at least 6 to 7 crores of investments we might do, right? Roughly, sir?
It all depends on market dynamics. We would want we add on to franchisee partners as long as possible, because that gives an additional entrepreneur joining the business force, right? So our focus is that because the stores are performing well and we are easily accessing franchises, there are last year we have added 6 franchisee partners. This year also we would want to continue adding franchisee partners. So it's very difficult for me to quantify the CapEx investment that we'll be making this financial year.
Okay. Fair enough, sir. And so this last question from my end, in terms of working capital, I think our receivables are around 150 days. So is it because more is sold to franchisee? What can we expect going forward in terms of our working capital cycle? Because it's a significant cycle, right?
Yeah. So I think we have been able to bring down our effort was to bring down by 10 days the working capital cycle. We have been able to bring it down by about 9 days this finance. So 169 is now 160 approximately.
Okay. And will it be further down this year?
Our effort will always be to reduce this by 10 days every passing year.
Okay. Fair enough, sir. Yeah, I'll join back in the queue, sir. I have more questions, but yeah, thank you so much. All the best. Yeah.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Devesh Dhawan, an individual investor. Please go ahead.
Can you repeat whom am I speaking to? Sorry. Yes, gentlemen.
Devesh Dhawan, sir.
Sorry?
It's Devesh Dhawan.
Devesh. Okay, Devesh. Okay.
Hi,
yes,
sir.
Mr. Devesh.
Congratulations on a good year. I had 2 questions regarding this. Earlier you guided 90 EBOs by 2028. So currently we are sitting at 75, net 75. So what's the plan right now? Are we ahead of what we were projecting, or yes, this was the kind of number we were looking at the close of 26.
So
and secondly, sir,
yeah. Okay. No, go ahead, please.
Yeah. And secondly, sir, I'm seeing per square feet revenue growth. It's just 4%. So that is roughly the rental growth at most of the commercial spaces we are at. So how are we planning to increase the per store efficiency? Because that the per square feet growth number looks a bit weak this year. And sir, one more from my side is we are opening new EBOs, so this is a brand building exercise overall. Now Sweet Dreams, after opening 75 EBOs, is a stronger brand in itself. So how are we able to make synergies from our traditional franchise business or the business that generates more revenue for Sweet Dreams right now? So how are we able to expand our margin there by, pre-IPO or pre-EBOs? Sweet Dream was not, the brand presence was not there. So how brand synergies are coming into play? Please explain that.
Right. Wonderful, Devesh. First of all, the number of EBOs question that you had. So in the current financial year, we'll easily cross 100 EBOs and much more. That's the outlook for the number of EBOs. In terms of per square feet sales, you are right that we have grown by about 5%, and that's the rental increase. Generally we sign 15% for 3 years in most cases. It's not an annualized increment for us. However, we would like to make it have a double-digit growth. No. The second thing is the other same-store sales growth number, which has come to around 13.5% for us, right? So in the overall efficiency point of view, although that 16,000 is a 4%, 5% increase, our same-store sales growth is 14%, 13.5 to 14%. In terms of your question related to brand strength, yes, with EBOs, the brand strength is capitalizing. Structurally, the MBO business or the general trade business is under severe stress because there are so many formats which are being opened by corporates, and there are a lot of brands which are shrinking in this channel in double digits. But historically, if you see, Sweet Dream continues to maintain its share, and the revenue from that channel is dropping, but the revenue from rest of the D2C channel continues to increase. So that itself is giving us an assurance that the brand stays in mission and doing in the right direction. Have I answered all your questions?
Yeah. Thank you. That's all from my side, and best of luck for future growth.
Thank you, Devesh.
Thank you. The next question is from the line of Vinod Shah from BS Ventures. Please go ahead.
Hello, am I audible?
Yes, Mr. Vinod.
Yeah, good evening, sir.
Good evening.
Sir, can you help us understand what is the average operating cost per store? Like rent, what is the rent, and what is the typical leasing?
So the cost of doing business, there are various components which all is grouped under cost of doing business, which is around 40%.
Okay. And like what is the typical tenure of the lease period?
Lease period generally is 5 years. In some cases, it is 9 years. We also sign some short-term stores, but those are exceptions, which is called a pop-up store. Pop-up stores are generally 1 year, but we have, there's exceptionally, these are very exceptions. Not a general trend.
Okay. And how many employees are typically required to run a EBO?
We generally operate in 1+2 format.
Okay. Like, has there been any instances where stores have been shut down in last 12 to 18 months?
Oh yes, it's a continuous process for us. What happens is in a retail expansion, when we are opening stores with such high frequency, the mistakes are bound to happen. Last year we closed 4 stores which were not performing, and the trend will continue. I think 10% of stores every year from operational stores, the bottom 10% we would ideally exit and keep correcting the channel.
Okay. And have you considered onboarding any major celebrity or brand ambassador to accelerate this category of awareness or building the overall brand of Sweet Dreams?
We are still in this expansion and strengthening of distribution of our EBO channel, At the right time, we will consider this, but nothing immediately is planned.
And currently, do we have any brand ambassador?
As of now, no popular face. Because the brand before 5 years has moved on to an international face, and it's a strategic move that we are hiring international good-looking faces for the brand.
And what percentage of sales come from online?
Online is 13%.
Okay. And are we available on quick commerce like Blinkit, Zepto?
We have tried quick commerce. See, our biggest marketplace is Myntra, followed by Amazon, Flipkart, Nykaa. But quick commerce, because of the distribution of their stores, their dark stores, we haven't found a successful launch of our category on that platform.
Okay. That's all from my side, sir. Thank you.
Thank you. Participants who wishes to ask a question may press star and one. The next question is from the line of Priyansh Miri from NGP Family Office. Please go ahead.
Yeah. Hello. Hope I'm audible.
Yes, Priyansh.
Yeah. Sir, I have a few questions. First one is on the same-store sales growth, sir. So, given that we have opened few new EBOs, right? If you exclude those, like those who are open in financial year 25, right? What are the normalized same-store sales growth for those?
This is what I said is the EBOs which has completed 1 year in last financial year, those only I have said is 13.5%.
Understood, sir.
EBOs which are fully operational in the financial year.
Oh, okay. Understood, sir. Sir, and what are the monthly revenues that these EBOs have who are like mature for at least 1 year?
I wouldn't have the bifurcation, but we are doing our run rate currently is around 6.5 crores as revenue from EBOs.
Total rate. So if I divide that by say 50, like
75.
Sorry, sir. Not.
We have 75 operational EBOs, which is generating about 6.5 crores of monthly revenue as of now.
Okay. So 50 EBOs generating in total 6 crore.
75 EBOs.
Understood, sir. Sir, one more question. Like I was checking our number between the gross profit and our EBITDA number, right? Like almost more than 50% is on other expense. So I assume marketing is also included in the other expense, right?
It is included.
Yeah. So what is the percent, sir, marketing out of the total other expense?
You have the exact number in club?
Sorry,
7 crores.
should I repeat?
7%.
7%. Then what is a big contribution, sir, in the other expense part of it then?
Can you remove the percentage? Sorry, we can't understand what is it. Yes.
I just want to understand the breakdown of other expenses. What are the big items within those other expenses?
So we have rent, we have commission, because the store rental also falls below in other expenses. No, we are not following Ind AS. We are in the IGAP accounting. So marketing, all repairs and maintenance, labor charges, professional consultancy fees, our expenses, all these things for the expenses.
Understood. Okay, sir. Understood. Yeah. Sir, one last question from product side. This night garments that we are targeting, right? It is for mostly for adults, right? Is there any plan to extend it to children or any different categories that we are looking into from a product strategy point of view?
Current trend is about 64% which comes out of women. About 28% is from men gender, and 8-9% comes out of kids.
Okay. So going ahead also, our key target will be on women side of the business, right?
Yeah. This will continue to be the strong brand for us.
Okay. So, and is there any new product line that we are also planning, or we are going to just focus on EBOs and the women segment as of now? Any guidance on that?
See, we have a big play area. As we said, we have a time zone from 8 p.m. to 8 a.m. Right. So that's a very large time share that we have, and we continuously keep on dissecting the lifestyle of people in that 8 p.m. to 8 a.m. and keep offering solutions based on emotions and moods. That's the structural uniqueness of Sweet Dreams. So we will add any product category as such, but within clothing needs from 8 p.m. to 8 a.m., we'll keep on innovating products, researching products, and offering solutions to consumers. Make them feel good and feel comfortable.
Okay, sir. Sir, pardon me, I have not exactly searched on the exact product that we offer, but during this time, innerwears or lingeries are also, are we already introduced in those categories or?
Our products start when you undo innerwear.
Okay.
So when you are back home, generally in the lifestyle, people undo innerwear and get up to sleepwear. Right? So we don't intend to get into innerwear.
Understood. So going ahead also, like players like Clovia and other, those will not be our direct competitors, correct?
There's enough strength and depth in the category that we don't need to look left, right.
Okay. Understood, sir. So thank you for patiently answering my question. All the best for the upcoming quarters.
Thank you.
Thank you. The next question is from the line of Ankur Agarwal from Motorzack LLP. Please go ahead.
Hi, sir. I wanted to understand, we have grown our revenues consistently, and I wanted to get a feel from your side of when can we see the operating leverage that our profits can move from 9-10 CR to 15 CR or 20 CR. What kind of levers we are having, and when can we pull them?
See, directionally, next 2 years, we are aiming at capitalizing on the category expansion, investing into marketing, right? Operational efficiencies, our focus will turn when we see that the market has become steady and there's limited scope for expansion or growing of the category, right? Because the more we earn, the more we generate gross margins, we'll keep pumping into marketing, right? It's a vicious cycle. So the objective, I think, at least for a year or two in the near future, looks at expanding the growing sales, building awareness, strengthening brand, building infrastructure, investing into manpower, right? And then after a couple of years, I think the operational efficiencies will kick in and suddenly you will start seeing magical numbers.
Yes, sir, definitely, sir. So, sir, actually, we have already pulled our levers. Our gross margins are better, right, in this year compared to last year. And so, sir, whatever EBOs we have opened in this year, so or which are not mature enough. So, do you see when the sales are going to increase in this year, so do you see that, maybe we'll get operating leverage and it will flow into our profit after tax, because that fund will give us, more ammo to maybe, grow further?
As I said, our priority would always be in building infrastructure, hiring more professionals, marketing, right? Opening more EBOs. That would be our core focus because we see untapped potential there. There is a huge unorganized market. There are umpteen number of malls and markets where there is no destination sleepwear store, right? So these are our priorities at this point of time. And once with scale and all this kicking in, the operational efficiency will convert into numbers. That's our belief.
Got it, sir. So these older EVOs that we have, do we see any kind of fluctuations negatively in monthly retail numbers, or like they are stable and growing? I mean, do people buy once and forget for some time? How does it play out?
So if the same store sales growth is say 13.5%, this includes stores which has grown at 40%, and this includes stores which have degrown at 10%, right? There are structurally some markets, suppose there is a new mall coming up, right? Besides the existing mall, there is structural shift of customer base. These things are part of the journey. But the overall number is very important. The overall number across 51 stores, which were operational for both the years, is 13.5%.
Understood, sir. Sir, actually, my direction was like, last time we were on the call, so we had a understanding that as more business shifts towards EBO, more operating leverage we'll have and, more bottom line we can generate. But our bottom line is kind of like stagnant year on year. So that was
it has improved over last year. Okay.
Yeah.
But the operational efficiency is too soon to kick in, is our belief. I think we will still need at least 1 year, or maybe, to be fair, a couple of years before the numbers start shining.
So, sir, like when you have board meetings and also after 2 years, like what kind of figure you see, where do you see the company directionally? Like not numbers and all, but what kind of a...
You can put your own math. We'll continue to grow at higher double digit, right? Our growth channel is EBO. Practically, we are doubling EBO sales year on year. Our digital B2C website growth also is going to be continue at a very high percentage, northwards of 50% year on year. Right? So you can put your own math and derive a number.
So, like, what kind of EBO revenue we are targeting for this year, just for the EBO? Or
in excess of 80 crores.
Okay, we are targeting in excess of 80 crores. That's a good number.
Yeah.
So that will maybe give us some kind of operating leverage in terms of margins and all, right?
Yeah.
All right. Thank you so much, sir.
Thank you, Ankur.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Ganesh Nalawade for closing comments.
Thank you everyone for joining the conference call of SD Retail Limited. If you have any further queries, you can write to us at research@kirinadvisors.com. Once again, thank you everyone for joining the conference.
Thank you. Ladies and gentlemen, on behalf of Kirin Advisors Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.